Welcome back to TalkTickers, your weekly deep dive into earnings calls.
That's right.
Today we're unpacking the Q1 2025 earnings call from Mastech Digital Incorporation.
Yep, we've got the transcript, the prepared remarks, the Q&A, all of it.
Our mission, as always, is to pull out the key takeaways, the insights, maybe some surprising details, basically give you the context without you having to sift through everything yourself.
Exactly. And Mastech's Q1, well, it painted a picture of a company growing, but maybe cautiously, while making some big strategic moves.
Okay, so let's start with that overall picture.
Yeah.
What were the main financial results they reported for Q1 2025?
Right, the headline numbers, consolidated revenues came in at $48.3 million.
$48.3 million. And how does that stack up year over year?
That's up 3.2% compared to Q1 last year, so, positive growth.
Okay, 3.2% overall. But they have different parts to their business, right? How did the segments perform?
Correct. Two main segments. And the data analytics segment, well, that was the faster grower this quarter.
How much faster?
Revenues there hit $9 million. That's up 11.1% year over year. Pretty strong.
11%. Yeah, that's solid. Any forward-looking indicators there?
Definitely. Order bookings in data and analytics were $11.7 million. That's a nice jump from $9.6 million in the same quarter last year. So building a pipeline?
Good sign. Okay, so data and analytics driving growth and bookings. What about the bigger piece? IT staffing.
Right, IT staffing services. That brought in $39.4 million in revenue.
Still the lion's share. How is its growth?
Up 1.6% year over year. So positive, but, slower than DNA. Still contributing, though.
Okay, so top line growing, led by data and analytics. Now, let's talk profitability. I saw something interesting about gross margins.
Yes, absolutely. So consolidated gross profits increased 6.3% year over year, a bit faster than revenue growth.
Which implies margin expansion.
Exactly. Consolidated gross margins improved by 80 basis points compared to Q1 2024.
Hold on, 80 basis points, that's 0.8 percentage points, right? That's a decent jump for a quarter.
It is. And here's the slightly surprising part. They specifically said this improvement was largely driven by increases in the IT staffing business.
Really? The slower growth segment, not data and analytics.
That's what they said. It suggests maybe better rates on staffing contracts or perhaps some internal efficiencies kicking in there. It kind of makes you pause.
Yeah, that is interesting. Usually you'd expect the higher value DNA work to lift margins more. Okay, moving down the P&L, what about the bottom line, net income?
Okay, so on a GAAP basis, that's the standard accounting rules, they actually reported a net loss, $1.44 million or 12 cents per diluted share.
A loss. How does that compare?
It was a larger loss than the same quarter last year, however.
The non-GAAP number.
You got it.
Right.
They also gave a non-GAAP net income figure, which adjusts for certain items. That came in at $0.8 million or 6 cents per diluted share.
And how does that compare?
That was flat year over year, zero change.
So the standard accounting shows a loss widening, but their adjusted operational view shows a small profit holding steady. That's quite a difference.
It really is. And analysts often focus on that non-GAAP number to gauge the sort of underlying operational health. Of course, you always need to see what they adjusted out. They said SG&A details and the reconciliations are in the release.
Right. And financially, how are they looking overall? Cash situation, debt?
Pretty solid, actually. They ended the quarter with $24.7 million in cash.
Any debt?
No bank debt outstanding. And they still have access to $23.7 million under their credit facility if needed. Good liquidity.
Okay. And are clients paying their bills on time? DSO?
Days sales outstanding, yeah. Stable at 56 days. They mentioned that's right in their target range, so receivables look well managed.
All right, good grasp on the numbers.
Yeah.
Let's shift gears now to the management perspective.
Yeah.
The ECO is relatively new, right? About 100 days in at the time of the call.
That's right, just over 3 months. And he used some pretty strong language to describe the current situation.
Oh, yeah. What did he say?
He called it an inflection point for the company, suggesting that the choices they make now are really critical for their future path.
An inflection point. That implies big changes. What's the core direction they're heading?
It's all about AI-driven digital modernization. That's clearly where they see the market going and where they need to be to serve their enterprise clients.
Makes sense. And a big part of that strategy seems to be a specific partnership.
Yes, they spent a good amount of time talking about their expanded partnership with Informatica. They really stressed it's moved beyond just a typical vendor relationship.
How so? What does strategic level mean here? Is it just pushing more Informatica licenses?
No, much more integrated than that. They're talking about co-developing industry-specific accelerators. Think like pre-built components to speed up projects,
Okay.
and even creating something they called an outcomes lab.
An outcomes lab, what's that?
The idea seems to be a joint space, virtual or physical, where Mastech and Informatica teams work together, maybe even with clients, to build specific, repeatable solutions focused on delivering measurable business results, the outcomes.
Ah, okay. So it's about building joint solutions, not just implementing tech.
Exactly. They expect this to bring in better quality deals and really differentiate them from competitors just providing bodies or basic implementation.
That definitely sounds like a step up in positioning.
Yeah.
The CEO also mentioned internal transformation efforts, showing early signs of progress.
Yeah, he used that phrase, early signs of progress, showing up in the quarterly numbers. Didn't tie it to a specific metric, but you could maybe link it to those improved gross margins and staffing, perhaps?
Plausible, better efficiency, maybe, and they have a bigger strategy reveal coming.
Yes, they plan to unveil their full go-forward strategy later this year.
And the gist of that future strategy is?
To position Mastech Digital as a key partner for Global 2000 companies that are trying to become AI-first organizations.
AI first. Big buzzword, but what's the synergy for MadTech?
It's about combining their strengths, using their data modernization skills to get clients' data ready for AI, and then leveraging their IT staffing arm to supply the specialized teams needed to build and run those AI systems. Kind of an end-to-end play.
Makes sense. Offer the whole package. But they didn't ignore the economy, right? What was the tone on macro conditions?
No, they were quite direct about it, acknowledged a cautious approach from clients. Decision-making is more deliberate. They even mentioned considerable turbulence noted by others in the industry.
So they see the challenges. How are they squaring that near-term caution with their long-term AI optimism?
Their take is that companies aren't stopping transformation, but they are reprioritizing spend. Budgets are tight, so clients need projects with clear, fast payback, high ROI.
And MadTech thinks their AI and data stuff fits that bill.
That's the argument. These projects can unlock efficiencies or create value quickly, justifying the spend even now. They believe their offerings align well with that ROI focus.
Okay. And the CFO is also new. First month done.
Yep, just onboarded. His focus, he said, is on driving agility, discipline, and scale across finance and operations.
Building on the existing foundation, I assume.
Right. Leveraging what's there, but making sure the team systems and processes are aligned and resilient, especially for this AI-first push. Think operational tightening and financial control.
Got it. Okay, let's dig into the Q&A. That's often revealing. Someone asked about the data and analytics margin dipping, right? Even though revenue was up.
Yeah. Good catch by the analyst. Management said it was mainly two things. One, lower utilization of DNA consultants during the quarter.
Meaning people on the bench.
Essentially, yeah. Less billable time. And second, a one-time reserve adjustment they had to make on a fixed price project.
A project maybe went slightly sideways. How much did that impact the margin?
They estimated the combined hit was about 2 percentage points on the DNA segment margin. And they stressed the reserve was a one-time thing.
Okay, so hopefully temporary. What else came up? Back to Informatica.
Yep. An analyst wanted more specifics on how that partnership actually works day to day.
And the answer was?
They admitted some specifics are still being ironed out. But the vision is clear. Resources committed from both sides, jointly going after opportunities, building solutions with clients, presenting that unified front.
Integrated approach. Got it. What about stock buybacks? Always a popular topic.
Right. So the board extended the buyback program for another year until February 2026. There's still authorization for about 423,000 shares left.
But did they actually buy any shares in Q1?
No, they didn't. And the reason given was interesting. Extended blackout periods.
Blackout periods, usually related to earnings or...
What else?
They linked it to corporate transactions and events during the quarter. Didn't elaborate on what those were.
Corporate transactions and events, conveniently vague.
A little bit, yeah. But the key message was those events are past now, and management said they expect to get active on the buyback going forward.
Okay, so watch this space on buybacks, potentially restarting. What about headcount? Billable consultants.
They finished Q1 with 991 billable consultants.
And how does that compare to the previous quarter? It was actually down slightly, a decline of 15 consultants.
Down 15. That could tie back to that client caution and slower decisions they mentioned.
Seems likely, yeah. Especially if the slowdown hit the staffing side more.
Did they talk about the pace of demand during the quarter? Was it steady or lumpy?
They said no significant lumpiness month to month. They saw growing demand overall, especially for the AI-driven modernization stuff, and they expect Informatica to be a catalyst there.
Any particular industries showing strength?
They describe demand as broad-based, but they did call out having prior traction, meaning existing strength, in healthcare and life sciences specifically.
Okay. And circling back to the CEO, any final thoughts from him on navigating this environment?
He kind of doubled down on being cautiously optimistic, re-emphasized that clients are scrutinizing deals, demanding those high-impact ROI-aligned solutions.
Projects with clear payback.
Exactly. And he believes their offerings hit that sweet spot. The talent business, he noted, can pick up fast when things loosen up. While the AI and data capabilities are crucial for long-term transformation, the kind of stuff clients will fund if the ROI is there.
Makes sense. One last detail, bill rates. How are those trending?
That was another positive point, actually. The average bill rate in Q1 was trending between $84.50 and $85.50 an hour.
Okay. How does that compare?
It's up. Last quarter, it was more like $83 to $83.50. Then this time last year, it was around $79.
Wow. So even with cautious clients, rates are climbing quite nicely. Why?
They attributed it mainly to getting higher rates on new assignments and also the type of skills being deployed.
So shifting towards more valuable specialized skills.
Precisely. More of that higher-end data and analytics AI transformation work, which commands premium rates. It fits the whole strategic narrative.
Okay, that really paints a full picture from the call. Thanks for breaking that all down.
No problem.
Yeah.
So summing it up, Mastech delivered, pretty solid Q1 results given the environment. Data and analytics growing well, IT staffing resilient and helping margins. Big strategic push into AI with Informatica.
Right, but balanced with that near-term caution about the macro climate. And the plan to restart buybacks is definitely something folks will watch.
For sure. Understanding all these pieces helps you see how they're trying to manage the present while building for a different future. It's that classic balancing act.
Exactly. It gives you, the listener, a much clearer perspective on their strategy and execution in a pretty complex market.
It's more than just the numbers. It's the story they're telling.
All right, now before we wrap this deep dive, it's time for our regular segment where we engage in some blue sky thinking. Just to be crystal clear, this is not financial advice.
Definitely not. Purely hypothetical brainstorming here, the what if corner.
Precisely. So, considering everything they said about deepening the Informatica partnership, the co-development, the outcomes lab, the focus on high ROI solutions, here's an outrageous but maybe plausible thought experiment for you.
Okay, let's hear it.
What if this partnership gets so tight, so integrated, especially in specific verticals like healthcare, where Mastech already has traction? What if they effectively become Informatica's go-to, maybe even primary recommended partner for certain complex AI and data modernization projects built on the Informatica platform?
Moving from partner to preferred or primary partner, that's a significant leap, but you can see the narrative thread they laid out.
Right. If that were to happen, you could imagine a scenario where Mastech's access to high-value pre-qualified deals through Informatica ramps up significantly faster than the market expects.
Which would boost their data and analytics growth and maybe even margins further.
Exactly. And it could lead the market to start seeing Mastech less as a general IT services firm and more as a specialized high-growth AI solutions provider deeply embedded with a major tech platform.
Potentially justifying a higher valuation multiple over time. That's the theoretical payoff.
Now, the outrageous part is assuming that level of exclusivity or primary status actually materializes partnerships are complex. The plausible part is that deep co-development could naturally lead Informatica to lean on Mastech for the trickiest projects they built together.
Big caveats, though. Execution risk is huge. The timing is uncertain. And how much impact those buybacks actually have is another question mark.
Absolutely. High potential reward, but definitely high risk and uncertainty. Just a scenario to chew on based on the strategic direction they highlighted.
Food for thought, definitely.
And on that speculative note,
that brings us to the end of this TalkTickers deep dive.
We covered Mastech Digital's Q1 2025 earnings call. Hopefully this breakdown gave you a clearer understanding of their performance, their strategy, and what they're seeing out there.
We hope it was useful. Thanks for tuning in.
Until the next deep dive.